Good morning and welcome to our Rathbone Model Portfolio Service webinar. My name is Jerry Lawler and I'm a Business Development Director at Rathbones, and I'm delighted to be your host today. I'm also joined by Andrea Young, our MPS Investment Director, and David Coombs, our Head of Multi-Asset Investments. Andrea, David, thank you both for joining us today.
Morning.
During the session, we will explore everything our uniquely diversified, actively managed and highly cost-effective model portfolio service has to offer. Andrea and David will share how this enhanced service has been constructed with 3 dedicated Rathbones multi-asset building blocks, which will be used across 7 model portfolios. We believe this service offers a distinctive investment solution tailored to meet the needs of your clients. So the first question you may ask is, why now and why another MPS in an already overly crowded market? Well, following the combination between Rathbones and Investec Wealth and Investment, we took our time to consider the best approach and combined Investec's expertise in managing model portfolios and Rathbones' long-term track record in running multi-asset portfolios. On the 22nd of September, we launched the Rathbones MPS, providing a directly invested, actively traded service using our new building block funds, which are underpinned by Rathbones' multi-asset allocation risk framework. We are aware that lots of clients have both multi-asset and MPS options on their CIPs, and therefore we wanted to provide greater choice and flexibility for you and for your clients. So what do we think is different? We are directly invested, meaning we are accountable for every trade. There's no mechanical rebalancing. There's a 0 DFM fee, and the OCF is capped at 0.5%. Plus, much more than that, we will touch on later on. Before we begin, I'd like to draw your attention to the right-hand side of your screen. Here you can use the Q&A tab to insert your questions, and I'll come back to those later on. You can also download our latest collateral under the Resources chat tab, which will provide you with more information about our MPS. Finally, there's also a survey which we'd encourage you to complete. We always value your feedback, and it enables us to continue to improve these sessions. So, Andrea, turning to you, can you please kick off and tell us about the proposition and why you think we are different?
Yeah, definitely. So if we look back and we look at the Rathbones and Investec combination, that really allowed us to review our MPS offering. And what we've been able to do is take the time to review that offering and see where we could address some of the common frustrations with an MPS on platform service. So I think it's fair to say that we have taken a lot of time to try and get this right, and we've looked at every aspect of the service. So one of the ways that we've enhanced the proposition, as you've mentioned, is we've got this building block approach. So that is 3 actively managed funds, and these funds are designed to work together and complement each other. So you can't buy these funds individually. They are designed only for the MPS solution. And really what this has allowed us to do is to be able to invest directly. So we've got a much broader investment universe to be able to enhance returns. And more crucially, we've got greater control over risk. So looking at the models themselves, you've got 7 models across that risk spectrum, going from low risk to high risk. And these models have been designed to fit the de facto risk ratings. So that's risk ratings 2 to 8. And essentially it gives advisors reassurance to know that if they select a particular MPS model, we'll be managing it in line with that risk framework and within those particular parameters. And you also mentioned as well about the cost. So we do believe that it is a very cost-effective solution. So like you say, we've got a 0 DFM fee. We've got an OCF cost cap of 50 basis points. Now, in reality, that OCF probably comes in a little bit lower, but the cost cap is there because, again, it provides reassurance to know that we're not going to allow those costs to drift higher over time. And I think finally, I want to focus on transparency as well, because I think one question that advisors might ask is, well, if you've only got 3 funds, how are we going to know what's invested in it? And that's why when we've looked at the reporting and the service that we deliver, we're going to provide full look-through reporting so advisors can see under the bonnet of these 3 funds and they can see exactly what their clients are invested in. So ultimately, really, it's about providing something that is not only cost effective, but we think that really adds value for clients.
Brilliant, thank you. And a very good point about the cost, actually. Whilst capped at 0.5, I think some of the strategies are coming in around 47 basis points.
That's
so
right.
yeah, it's great to see.
Yeah.
David, coming across to you. Andrea touched on the building block funds. Can you provide some more detail from your perspective, please?
Yeah, I mean, as Andrea said, we launched these funds specifically and exclusively for the MPS. They are not available outside, and that's really important because the funds themselves don't really stand alone. We do run one strategy just split between the three funds, and perhaps I'll just go into a little bit more detail of how that works. When we talk about risk, often we talk about volatility or drawdown, but actually, when you think about a client's risk profile, time horizon is a key factor that often gets kind of missed. And so when we designed our MPS, we thought about liability matching, if you like. That is, making sure for lower risk clients that typically have a shorter term time horizon. I say typically, can't put everyone in the same boat, obviously, but typically lower risk because you have less certainty around future spending patterns. So we have the first fund, is called the liquidity fund. As it sounds, I mean, passes the kind of Ron Seal test. It is quite liquid. It invests in liquid assets, and I'll come back to that in a little bit more detail in a moment. As you might expect, you would tend to have a greater exposure to this fund in the lower risk strategies, where there's that potential demand for cash. These investments will also be less linked to equity type risk, because again, for clients with shorter time horizons who need cash quickly, you don't want to be selling, say, equities during a period like last week, for example, when we've got some volatility around. So that's the first fund. It's called the Liquidity Fund, and as I say, I'll talk a little bit about what's in that fund in a moment. The second building block fund is called the Equity Type Risk Fund. Again, Ron Seal test here. Sorry, anyone under the age of 40 might need to Google that. This is basically, think about the asset classes that tend to be highly correlated during periods of market distress. If we think back, for example, we don't really want to remember it, but 2008, the global financial crisis, when you had a big correction in equity markets, you saw very significant falls in corporate bond markets as well. Some corporate bond funds were down nearly 40% at that time because they had quite a lot of exposure to high yield. So it's those risk-on asset classes. Now, typically, they're the ones that generate the higher returns, and if the risk-return ratio works properly. So again, you'd expect to have much more in this building block in the higher risk funds, right? And again, I'll talk a little bit more about what's in them in a second. The final building block fund is called Diversifiers Fund. You're getting a theme here, right? They kind of, we didn't spend a lot of money on branding here. This is basically where you might hold some gold in the portfolio, some traditional alternative investments, precious metals. For example, you might expect to see some property in here that there isn't at the moment, but you might, I guess, at some stage. It's also where we invest a lot in structured products, and again, I'll come back to those. But we're looking here for particularly investment strategies that have a very low or negative correlation to both of the other two funds. So that fund might go down for a whole year, but we're okay with that if the other two funds are going up. I mean, again, basic portfolio diversification there. Okay, so what's in them? And this is again where I think we're very different to many of our peers. So going back to the first fund, you remember was called the Liquidity Fund. That's principally cash. That is it's a legitimate asset class right now. We get 25 basis points below base rate for cash interest, so not to be sniffed at, given where inflation coming down. But also it's sovereign bonds and any corporate bond above a AA rating. Now, when I was investing 30 years ago, there were lots of bonds over AA rating. Today, there are very few, so it's principally sovereign bonds or supranational bonds like a World Bank, European Investment Bank, that kind of vehicle. So as you can tell from what I'm saying, now I was going to say there's not much credit risk, but there's quite a lot of credit risk with gilts at the moment, and maybe we'll come back to that later in the show. But principally, these are kind of your safe haven assets. Very liquid, can trade in size at any moment in time, and we do run over 9 billion across the multi-asset suite, so that liquidity is really, really important. And that's it. It's very much based. Oh, it is global. I should say it's global. So for example, we'll have US in there and others, and we'll talk about strategy a bit later. But it's global sovereign bonds. We are able to hedge the currency risk, which we do actively, which again I think differentiates us. And because we are investing directly, we know exactly what's in the portfolio. We can be very precise in the currency risks that we want to take or not take. And again, perhaps we'll come back to that when we talk to strategy. In the second fund, the equity risk type fund, this, as you would expect, has all global equities. We're principally investing directly into large and mid and large cap equities globally. That's a global definition of mid cap, not the UK definition. So typically we're looking at stocks that would get into the FTSE 100 at the minimum. And if we want to invest in small caps, we'll probably use ETFs, for example, but that tends to be more tactical. So we have global equities, not a surprise. But also all corporate bonds below that AA rating go into this vehicle. So we treat corporate bonds as equity type instruments, and they have to battle to get into the strategy alongside equities. So when spreads are very narrow, for example, as they are today, we have very little exposure. We don't run a strategic asset allocation with a benchmark like many of our peers. So right now, it might surprise you to hear that we have literally less than 1% in corporate bonds. Emerging market debt would go in here, private equity would go in here, industrialized metals, commodities go in here because they are correlated to the economic cycle. So the way to think about the equity type risk building block is any risk on asset class. Now, we're never going to invest in Bitcoin before we get any questions, but if we did, we see that as a risk on asset, it would sit in the equity type risk bucket. Controversial, but there you go, it's tech bro stuff, right? And the importance about that is, of course, with market volatility such as we got last week, we're able to trade actively all the time. We can trade 24 hours a day, 6 days a week. We can trade in UK bank holidays. Really important, given we have a significant exposure to the US, that we're able to trade on UK bank holidays when the US market is open. So again, I think this differentiates us to many of our peers, is that it's active management 24 hours a day, 6 days a week. And we generally do trade into the evenings as well, because we have investments in Asia as well. So that's the equity type risk building block. And then the final building block, diversifiers, about 95% of that fund right now is in structured products. Perhaps we'll talk a little bit more about that later. But again, I talked about the fact we have over 9.5 billion across the fund suite that we run as a team. That gives us great scale in dealing with the investment banks directly to drive investment strategies that are bespoke and fit alongside the rest of our strategy. What we're not doing is buying off-the-shelf structured products necessarily. Sometimes we'll sit down with the bank and say what risk we're running in the other two funds, and can we find a strategy that dovetails with that and is negative correlated, and gives us genuine diversification. And this is bought at institutional rates. This will include, which I should have mentioned, in the equity type risk fund, we can also buy put options, which we have at the moment, for example. And again, that gives us another level of diversification that I suspect many of our peers do not have. So that's a long answer to your question, Jerry. Sorry about that, but there's a lot to get through. But hopefully by just going through some of those different types of investments in detail, you start to pull out some of those points of differentiation versus our competitors, and ultimately we're in control of all of those, can see them all in real time and act accordingly, which is super important as markets become more volatile, as they seem to be at the moment.
Brilliant, thank you. So just on the directly invested point, we're not using other people's third-party funds?
We use no third-party funds whatsoever.
Thank you. Andrea, coming back to you, you mentioned the efficiencies that the building block structure brings. Can you provide a bit more detail on what that means, please?
Yeah, definitely. So in addition to, on top of the other obvious like investment benefits that David just mentioned then, if we think about how an MPS on platform solution generally works, you'd have a lot of third-party funds. And for example, if you wanted to add a new exposure into the portfolio, what you'd have to do is then make sure that that fund would be available on all the different platforms that you're on before you can add it to the model. So being able to have the building blocks, being able to invest directly, it means that you can do it much more efficiently at a much quicker pace, and you can take advantage again of kind of any quick market movements more so than what you could with a more typical type solution. And I think if you go back to that point around rebalancing as well, we know that when you rebalance on platform, client assets to some degree can be out of the market. So, and that can be a day or two. And really what's happening there is that you've got to wait for the sales to price before you can make the purchases. So what happens is, yeah, clients can be out of the market for a day or two. With the building block structure, we don't have to do that. It can be a lot more efficient. So you've got less cash drag, and also there's less disruption to client accounts because there's less trades going on at a platform level. It means that clients, for example, if we initiate a rebalance and a client wants to take money out, for example, or withdraw money, they've got to wait for that rebalance to complete before they're able to do so with a lot of platforms. So it's kind of, we're reducing that level of disruption. So if you think about it, there's less disruption. That'll be less CGT crystallization events for your taxable accounts, and there's going to be less cash drag. So it's these types of efficiencies that we consider all small wins, and really it's about the long-term outcome for clients. We're able to tweak and enhance those returns by doing this building block structure.
Brilliant. A lot more efficient use all round, really, isn't it? Many
Exactly.
benefits. David, let's turn to your day job and look at the investment strategy. Can we look under the bonnet, and can you talk about what you are doing from an investment perspective today, please?
Yes. So, I mean, where do you start, right? So let's start with AI, okay? Because there's a lot of talk globally about AI bubbles. I was reading the press over the weekend. Lots of articles around AI bubbles and the amount of capex that's going on in the world, and are there going to be disappointments? In my view, yes, I think there will be disappointments. We were just discussing this morning about Walmart's work with OpenAI and whether some of these kind of new technologies are just glorified advances to the existing search functionality that Google had, and will Google end up winning out? So it does worry me slightly that there's been so much expenditure by various companies. My co-manager just come back from the States, met with 12 companies there. When asking them about their AI strategies, it's quite noticeable that they've got a good idea where they might just strip out some costs. They're definitely pausing on hiring in many cases, particularly at the lower levels. Not that surprising. But when you try and turn to the question, yes, but how are you going to enhance your returns? Are you going to be able to generate more profits, new revenue streams, new revenue lines? That's not so clear. So AI can't just be about reducing costs. It has to generate excess returns given the amounts that are being invested to get that return on capital. And I think that's why the market's really volatile right now. It's literally going company by company by company, sector by sector. It doesn't matter what the job, where you're listed, what sector you're in, or what country you're in. This is a global phenomenon, and I think we're going to see this continue over the next couple of years, which is not great for those who are nervous investors, but I'm afraid this is a revolutionary technology, right? And now we're starting to see that, and a lot of businesses are under pressure. A lot of companies are derating, or valuations are falling because people are worried that the AI will be a threat to their business. So you've got two things to concern yourself. One, all that money being spent on chips off NVIDIA, are we going to get a return on that? If not, that's going to be disappointing. Some companies, I suspect, will just go to the wall because they'll have overinvested, used debt, and won't get that return. Bit like .com. I think it's lazy to draw parallels, but there are some lessons that we can learn. And then there's the Kodak trade, right? It's or Blockbuster. You no longer have a business because AI is completely taking it away. And we're spending a lot of time thinking about that in our strategy. And so we're trying to invest in companies where we see that AI disruption threat much lower. We just added Stryker to the portfolios, for example, which is a US medtech robotics business. But also looking at those companies that have derated, things like Accenture, Adobe, Booking Holdings, the travel agent, where the market's saying you're going to be massively disrupted, the stocks are cheaper than they've been for a long time. We think that fear is overdone, and so we are investing in some of those companies. So AI is not a theme anymore. AI encompasses everything that you do, both at a macro and at a micro level. So that's a huge part of the strategy right now, is understanding who are the beneficiaries. So you want to own NVIDIA, that's in the portfolio, Taiwan Semiconductors, ASML, ASMI, Cadence is a software business that helps design these chips. So we have a very strong kind of AI hardware portfolio. Software is much more under threat, and we do own Adobe. It's probably cheaper than it's ever been. It's gaining revenues at 10% per annum, but it's being priced as a company that's barely growing at all because the market doesn't believe the growth, even though it keeps bringing it through. So and so we're really looking at each sector as a sub portfolio, if you like. So in technology, you want to invest in those benefiting from that AI build out. But we are worried that NVIDIA is now lending money to its customers to buy chips off it, and that there are real fears there. Hence, we've got the S&P 500 put options in the portfolio. But then looking at new holdings into the portfolio where we see that AI disruption being relatively low. You can't say it's zero, but that's a real focus. So Motorola is another company we've added to the portfolio pretty recently, where again we don't see that being disrupted by AI. It's more the platform businesses, because we like the look of companies like Uber and Spotify and some of these others, but we do think those platform type businesses are at risk. If you're going to push me on geography, we don't allocate by geography. We don't believe in it, but you know, we do think about the economies our companies are generating their revenues from, i.e. where are their customers, right? So take, for example, a company like Compass, which about 70-80% of its earnings are in the US, but it's listed in the UK. So we think more about the earnings. So if you were to look at the economies that we're trying to get exposed to, it's the US. We still think the US is going to provide the kind of the core growth for over the next 5 years. Yeah, the market's questioning that right now because of the impacts of the migration policies that Trump has been following and the tariffs, etc. There are concerns that US growth is slowing, employment's falling a little bit. And I think that's, again, adding to the AI volatility. But we think the US economy is much more resilient. Certainly when we talk to companies, they seem pretty optimistic. Now, US CEOs are very good at selling their businesses, but we do think there's a pretty strong economy underpinning this, and we also think it's like the US will cut rates, and we're going to go into a 2-year interest rate reduction cycle in the States. That will also support the US consumer, who's been taxed a bit because they're paying the tariff taxes right now. So the US is still a core part of the portfolio. And I think the other area that we think looks more interesting probably now than it has done for the last 15 years, and kind of the big switch in the way we're thinking about things, is into developing markets like Asia in particular, and Eastern Europe, like Poland. We think these economies are starting to, because their demographics are actually better than some of the Western economies, actually. You look at countries like Vietnam and Indonesia, we think it's really exciting. So we want to get more exposure to companies selling into those markets. And also, dare I say it, it looks as if China might finally be recovering as well. So in the E fund I talked about earlier, I'll be asking questions later, the equity type risk fund, it is dominated by equities, which may seem obvious, but given what equity valuations are, maybe less obvious. But we do think those economies are still generating excellent growth that we want to invest in. One notable mention there is that we don't think much of the UK economy, so we have very little exposure to the UK economy. In fact, we've been reducing our exposure to kind of the one stock that's kind of linked to the UK economy, and that's Next. Brilliant business, but we are very worried about the UK consumer. We're very concerned that the UK could go into recession. So, summarize, equities, focus on companies in non-AI disrupted sectors, looking at growth areas in the States and Asia. We do have some European listed companies, but again, global companies selling into the rest of the world. Pharmaceuticals, again, AI less disrupted probably. probably will help in reducing time to market of new drugs, although no doubt Mr. Trump will still want to negotiate lower fees if the trials don't take as long. We'll see. So that's where the equity exposure is. We don't have a benchmark, so I can't say we're overweight or underweight equities, but I would say we are fully weighted from a risk perspective. We are using our risk budget fully for equities. Moving on to other areas, corporate bonds, almost zero, as I mentioned earlier. We don't think you're being paid for the risk. The UK corporate bond market in particular is very focused on financials. We are increasing our bank exposure in the equity portfolio, so we don't want to have the same exposure in the corporate bonds. So again, the benefit of investing directly is obviously we're not going to own the NatWest corporate bond and the NatWest equity, for example. So we're making sure that we have proper, genuine diversification. So very little in corporate bonds, zero in high yield bonds. Okay, we're not afraid of going zero to an asset class. We have only 1% in what's called emerging market debt, and that's purely through Romania. I seem to talk an awful lot about Romanian bonds. It's a bit different, I suppose. But we bought Romanian bonds earlier in the year. They were yielding 6%. These are euro-denominated bonds, not local currency. And when we hedge that back to sterling, because UK interest rates are much higher than European rates, we get paid an extra 2% for hedging. So we're getting an 8% return from a government bond, a shorter dated government bond. We think that's a really good risk-adjusted return. And having that ability to currency hedge does enable you to enhance returns, but also allows you to be obviously fully diversified. So that's the equity risk fund. In the liquidity fund, very diversified. This is where I can talk a little bit about the UK. Not necessarily in a positive light, unfortunately. We do have approximately half of our sovereign bond exposure in UK gilts, and we have quite long duration. That's because we think the UK could be heading for recession. And if that happens, and the Bank of England might need to cut rates a bit more quickly than the market expects, that should be positive for bonds. You could see some equity type returns from gilts quite quickly. We've got 30-year gilts in the portfolio, which are quite volatile themselves. They're yielding approximately 5.3, 5.4%. If you think inflation's falling towards 2% next couple of years, as we think it will, then that's a real return of north of 3% for a government bond. If you think the FTSE's done about inflation plus 4% over the last 60, 70 years, if you're getting that kind of return from sovereign bonds, that looks very good on a risk-adjusted basis. However, there is the elephant in the room, which is, well, I'm not sure how I should put this really, Rachel Reeves' budget on Wednesday, in the sense that right now this government has zero credibility, in my view, in terms of its fiscal strategy. And the communications around this budget have been pretty woeful and have really created volatility. And it's not surprising that UK government bond yields are higher than Greece, Italy, Portugal, because there's this uncertainty about how strict she's going to be and whether she will keep to her rules. At the moment, the mood music isn't overly positive. So we're quite nervous holders of those government bonds. On the one hand, yes, good diversification for recession risk, generating positive real returns. Gilts haven't done that for a decade or more, right? So looks quite attractive. On the other hand, if they keep spending more money, the deficit keeps growing, unfortunately those yields could move a bit higher. So what we've done is we've diversified our sovereign bond exposure. So half it's now in gilts, the other half in a spread of other countries. Now, at one stage last year, that was almost all in the US. Since Mr. Trump came into power, we've reduced the US Treasuries from about 2%. That's unhedged because we want some dollar exposure. Sterling is quite vulnerable at the moment. And then we also have sovereign bonds in New Zealand, Australia, Norway, and Portugal, all hedged back to sterling. So we don't want to take the currency risk, but we do think that the credit risk of those countries is superior to the UK. And as I say, because UK interest rates are so high versus all of those currencies, we get paid to hedge, we get extra return for hedging and diversifying. So the liquidity fund has a reasonable amount of cash, not a huge amount, but some cash in there. but mostly in sovereign bonds, making up the rest of that part of the portfolio. So a really nice kind of barbell approach, I suppose. Your fixed income is pretty much all sovereign bonds, even the emerging market debt I talked about in the E fund earlier. The equity fund is pretty much fully invested in equities right now, but with a small amount of S&P put options as well, just to provide some protection. And then finally, I will get to the end of this, answer this question, Jerry. You did ask. The final part of the strategy is diversifiers. We have been adding to gold recently. That might seem somewhat surprising. We've done that within a structure though. So we've locked in the price, so we've capital guaranteed the entry point, and we only participate in the next 15% of the upside. But given where it is already, that feels like the prudent thing to do. We have some gold we've had from earlier that we've retained, but we've added to that position. And then the rest of the portfolio is in a number of different types of structured products. There are arbitrage type strategies. They are quite technical, curve trades related to commodity futures. I won't go into the detail right now, but if anyone watching wants to see a bit more on those, then please get in touch and we can take you through those. But you will not find those in many other funds, I suspect.
Thank you. Very thorough indeed. And I guess when looking back at AI, essentially we're spending billions to save billions.
Yeah, I mean, that's the danger, right? I mean, I think in my view, the biggest risk is they become highly commoditized. If you think about the internet, right, who thinks about paying for the internet? I mean, the internet is still run by cable, we all forget, right? We all think about it as Wi-Fi and the cloud, but actually the internet is cable right up until it comes into your house and into the data centers. But we just websites, it's all highly commoditized. We don't pay a lot for that anymore. And that's what worries me slightly is that, and the companies that built the internet, who knows who they are anymore, right? The Cisco's, okay, they're making a comeback now, but for many years, these companies didn't do very well. I think that's the danger, is that the companies that put all the CapEx into building it are not necessarily the ones that make the money. And if you think about the internet, who's made the money from the internet? It's been Google and Amazon. Well, they didn't build it, right? So it's not the people who build it, it's the people enabled by it who often, and they haven't had the CapEx. And I think, as I said, I don't like lazy parallels, but nevertheless, we have to be cautious of the way we look at this.
Thank you. And one final question for you, David, before we move to the questions we've been asked by those dialing in. The Mag 7, does that now become the Mag 6, based on what they're reportedly paying Elon Musk as we move forward?
Yeah, I mean, I question whether they were ever the Mag 7, to be honest. I mean, I think the Mag 7 has become an interesting issue in the sense it's become almost an asset class. And it's totally nuts, right? It's as silly as when we talked about, the BRICS. These made-up acronyms that people sell structures on the back of. Investment banks make a lot of money. Good luck to them. But Mag 7, these are 7 completely different businesses, right? I mean, if we look at Apple, we see Apple as more of like a luxury goods business. You look at Google, which, yes, makes money from obviously the cloud, but also from search and advertising. Meta makes a huge amount of money from advertising, which can be a little bit cyclical. Then you look at Tesla. Let's move on from Tesla. They're all doing something. And Amazon is a retail business, right? And yes, it's got cloud, AWS, etc. So they are sort of tech companies as well. But when you actually look at them underneath the bonnet, they're all very different and need to be treated very differently. We think Nvidia's earnings are probably at the moment the most reliable of the 7, but we don't think of them as a block. But unfortunately, they are dominating the indices, and therefore, we don't own Meta. We don't own Tesla. There is no way I'd invest in a company that was paying its CEO what they're paying that CEO, and the way that he runs that money as a personal that business. Almost like a personal fiefdom. We worry about the governance. I say we don't own Meta. We do own the other 5, but actually the ones we hold the biggest conviction in, which might seem surprising, is Nvidia, because actually it doesn't look that expensive, which I know seems a bit strange based on next year's earnings. The others, Microsoft and Alphabet, we also quite like. Apple and Amazon, we've been reducing.
Yeah, brilliant, thank you. Right, I'm going to turn to the questions. Andrea, I'm going to come to you first. Yeah. We've had a couple of questions about risk profilers and platform availability. Mm-hmm. Should we look at risk profilers first? I know we are risk mapped against FE. Who else is out there we can use?
De facto is the risk rater and agency that we align to, but we do risk rate with the major risk rating agencies. So that'll be, as well as de facto, Dynamic Planner, EV, Synaptic, Phenometrica, and Oxford Risk.
Perfect, thank you. And in terms of platform availability where advisors can use, I guess without mentioning those names now, plenty of availability out there that we can share with advisors as we move forward?
Yeah, exactly. So we're available on 14 different platforms. I won't go through them all, but you'll be able to see on the website which ones we are available on. And as we are open to, I guess, if demand suffices, we can onboard onto other platforms as well.
Brilliant, thank you. David, coming to yourself, in an overly crowded space with many different options, why would I pick the Rathbones MPS over a cheaper passive alternative option?
Well, I think if you're just focused on cost, you wouldn't, right? You weren't expecting that answer, were you? I mean, I think some people have just made their choice on they want to be in passive. We're not interested in trying to compete on price. Everything we've done when we were, I was working with Andrea to design this new proposition, it was always about investment led. Every meeting we had, let's make sure we get the least friction, we have the truest active proposition in the market, or as close to. You're never unique, okay? But what we've tried to do, and hopefully demonstrated during the course of this show, is that we've tried to take away as many of the administrative kind of quirks, if you like, that Andrew referred to as we possibly could. We're doing everything within the building blocks from an investment point of view. I'm not constrained in any way on a daily basis. That's hugely powerful. So we're not constrained. We're not constrained by anything, in actual fact. We're not constrained by indices. I know that one of our passive competitors right now is going out with their CMAs, that's capital market assumptions, where that the UK equity market's going to outperform for the next 5 years versus the NASDAQ. Well, I find that hard to believe, but a lot of these products are very quantitatively driven. We're not, I think for me, if you're an advisor and you're looking at your proposition, your CIP as you call it, you might want to have a passive option, and fine, crack on. But then you probably, if you're going to have an active option and thinking about consumer duty and assessment of value, etc., then surely your active proposition needs to be genuinely active. And I think we can absolutely point to that. We're not index tracking in any way. You can see that we have zero in corporate bonds, right? So we are totally unconstrained. We're unconstrained by geography because we can do currency hedging. We're unconstrained in terms of we can reduce our equity exposure by buying put options. We don't have to sell anything. Okay, so everything we've tried to do is to ensure that this is as active as you can possibly be, with the minimal amount of disruption to the client, reducing the tax burden as best we can. I mean, we can't completely remove it, but we've tried our best to do so. We've tried to do it at a price that we think is fair. You mentioned I think the OCF's around 0.47. It could well drop as we grow assets to 45, 46, don't know, but probably. We think for truly active OCF, that's pretty attractive. There's lots of other MPSs out there that have been running fund of funds with OCFs much higher than that. What have they been doing? They've been trying to reduce their active and buying passives to try and get that price down to compete with passive. We're not going to do that. I think advisors that are coming to us have decided they want an active option, and hopefully our price is competitive versus other actives, and that we can demonstrate value for money. Hopefully that'll come through performance. We've got a 16-year track record of our fund business that hopefully will provide some reassurance around that. Go away and have a look at that. You can do that yourselves. But I think that's what sets us apart. 100%, pretty much 100% active. A price that's fair to the client. It accrues on a daily basis within the funds. That's why there's no debit to the client cash account. That means the fee is charged on a daily basis, not at the quarter ends or month ends. So it's less, again, disruption to the client. It's fair. So I think it stands up. I mean, that's for obviously people watching the show to say, but I feel pretty confident that we've come up with something within the kind of constraints of the various 14 platforms that we have to deal with their various individual quirks, to provide a consistent approach across all 14 platforms. You really shouldn't be that much difference in performance across the 14. And I think that's a decent proposition, hopefully, at the right price.
Well, you've convinced me, I've signed up already. And I think actually you make a good point about the 14 providers. There will be platforms, there will be some platforms we maybe not be on, but I wouldn't let that advisors stop them from inquiring more, because if we're not on a platform, we're absolutely would be delighted to engage with that platform.
And I think the other point is that the MPS has these 7 strategies, but the team also run other funds in the sustainable world and income strategies as well within the fund side of the business. So hopefully that depth and breadth of different solutions in different models means that an advisor can come to us and literally find something that fits the suitability of if not all, but certainly the vast majority of their client base, and that again provides that reassurance of consistency of approach.
Yeah. And our role really is to educate the advisors to understand our proposition, and when they think it's right, then they know what they can select.
Yeah, we've got to be easy to do business with, right? And that comes right back to the report that Andrew was referring to. That look through monthly report. I should know that. Monthly report, where you can see the entire portfolio, that the client can see the entire portfolio. It's up to us to make sure that we give the advisors that information, that they can have a decent conversation with their client. But they know they're owning Apple, they know they're owning Adobe, they know they're owning, plugging the name out there, Roche, for example, and hopefully we'll give them the support there. And we do that not just through our quarterly reports, we also have a podcast, which again, I think it's not unique, but our podcast once a month talks for 30 minutes, comply to underlying client level, that talks about our current strategy. We do a spotlight on a stock each month as well. We're on episode 51, 52, so we've covered most of the equity of the portfolio so far. But again, the advisors can listen to it, their clients can listen to it, and all of our material is complied to underlying clients. So anything we produce can be forwarded on to the client.
Yeah, thank you. You make a couple of points there. Obviously, from our point of view, active trading is important. One question that's come through, one of the benefits of an MPS is the diversification built into multiple funds. Totally get the efficiency benefits, but is diversification the expense? The strategy's outcome is purely based on Rathbones' views?
It is purely based on Rathbones. That's the point. We're accountable, right? There's no committees running this money, right? There's my team. Ultimately, the buck stops with me at the underlying funds. You are getting our view. We've been running these funds for 16 years. We've got experience. But that's part of that is part of the proposition, is that we're on the hook. Any mistakes we own. We can't blame Schroders or Lion Trust or, we're in control of the strategy. That means it all fits together properly. I used to run fund of funds back in the day, I don't know, 10, 15 years ago, whatever it was. It used to frustrate me like mad because I'd have 15, 20 funds in the portfolio. I didn't have a clue what the strategy was on a daily basis. Some funds I wouldn't even see the look through for a month or so. So I couldn't really back my conviction or really precisely place the risk in the strategy, because and often you were massively over diversified, and sometimes you had funds that were doing the opposite of each other. You might as well have bought a tracker. Because if you buy a value fund and a growth fund, just buy the tracker, right? So blending multi-manager, I didn't find works. Okay, I think it's. And I think the fact that those models are kind of in decline in many cases is because that they're quite expensive and you have over-diversification. We are not over-diversified. We have about 120 investments across the portfolios. That's a lot of diversification. I went into the detail of what that is. But yes, you are buying my team's strategy, but we are accountable. You know who's making the decisions. You get that information. We can talk about those decisions straight away. You have access to quick information, and it's totally transparent, as Andrew was saying earlier. So you might not want that kind of proposition. You may want to spread it across 20, 30 managers. Yeah. I would suggest, and certainly my money is in this approach, as you probably expect.
No, thank you both. And with that, I'm going to call time on today's update. If there are any outstanding questions that haven't been answered, as long as you've left your details, we will come back to you with a response on those. Andrea, David, thank you both very much for your insightful views. For those of you watching, thank you for taking the time. We do hope you found our update useful. And as always, please do not hesitate to contact your usual Rathbones contact if you require any further support. Alternatively, you can visit the link on screen to find out more and get in touch with us. Please do enjoy the rest of your day. Thank you.